Hello, dear students. Welcome to SP Institute. We are studying observing rule of real accounts. Chapter recording business transactions under Chapter 2. Rule of real accounts. Debit it what comes in. Credit what goes out. Nominal accounts. Nominal accounts consists of the accounts related to expenses, losses, incomes, and gains. Nominal accounts are imaginary in nature, that is, they are prepared to describe the nature of transactions and to keep record of all expenses incurred by the business. Example salaries, rent, commission, etc. Next one. Rule of nominal account. Debit all expenses and losses, credit all gains and incomes. Next, rules of debit and credit. In a double entry bookkeeping system, every transaction involves two aspects, that is debit aspect and credit aspect. In order to identify which aspect needs to be debited or credited, rules of debit and credit are used. The following are the various rules of debit and credit under the different accounts. Personal account, debit the receiver and credit the giver. Next, real accounts, debit what comes in and credit what goes out. Third one, nominal account, debit all expenses and losses, credit all gains and incomes. General, the general is a book when all the business transactions are recorded on the daily basis in a systematic manner. Whenever a transaction takes place in business, it will be first received in general, because of which this book is also called as Book of Primary Entry or Books of Original Entry, format pro forma of journal. So debit side particulars, LF ledger folio number, debit amount rupees, credit amount rupees. See this following diagram. Nice table. Generalization. The process of recording the transaction in general is known as generalizing. This activity is applicable only to double entry bookkeeping system. The process of generalizing starts when any business transactions occurs. Journal entry. Recording of the financial information by debiting and crediting related to business are known as journal entries. Journal entries are passed based on the rules of double entry bookkeeping system, are the rules of the debit and credit. However, after passing the journal entry per a transaction, small description will be given, which is called as a narration. The narration of every journal entry should be started with the word being example, goods sold per cash, cash account debit, credit to sales account, being goods sold for cash. Next one, ledger. According to the LC Cooper, the book which contains a classified and permanent record of the transactions of a business is called the ledger. Ledger is an accounting book where the generalized transactions are being classified. It considered set of accounts and includes all types of business accounts, that is personal, nominal or real. Ledger posting. The process of transferring the entries from the general or subsidiary books to their respective ledger accounts known as posting. Following are the rules related to the posting. Number one, posting journal entry to specific side, that is debit or credit side. Second point, maintaining separate accounts for every transactions. Third one, balance remaining in accounts will shows the difference between debit and credit. Fourth one, to and buy using on debit and credit side of ledger. Next one, balancing of accounts. Balancing of ledger accounts. Balancing of ledger accounts is regarded as an important step as it gives the result profit or loss that account at a point of time. The ledger accounts are balanced at the end of every year or at a particular period in order to get the closing balance of that year. This balance will be used for preparing trial balance, debit balance. Excess of debit total over credit total in a ledger account is known as debit balance. Usually, debit balance is the amount of available on the left hand side of the ledger account or subsidiary in the books, which indicates profits. Example, suppose a company's cash account showing 4 lakhs as debit account and 3 lakhs as the credit amount, then the cash account will have a debit balance of rupees 1 lakh. Next one, credit balance. Excess of credit total over debit total in a ledger account is known as a credit balance. Usually, credit balance is the amount available on the right hand side of the ledger account or subsidiary books, which indicates losses. Example, suppose company's cash account showing 2 lakhs as debit amount and 2 lakhs 50,000 as credit amount. Then the cash account will have a credit balance of 50,000.